Greetings, folks. This is DC Investing. I've reached financial independence, and I'm talking about topics that may help others on their path to financial independence. And today, I'm going to talk about the Fed meeting that just lowered interest rates by a quarter point that happened last week. And the result from that is I got both a pay decrease, a pay cut, and a pay increase. And so it's an interesting topic. So basically, on any of the money market funds that I had, I got a pay cut, but on my margin account, I got a pay increase, and I'll explain the difference there. Um, so across all the different accounts that I have, I summed it up not too long ago, and I had about $250,000 in cash, which is basically just means it's in money market accounts. And these are funds that I just don't know what to do with yet. I'm invested in a lot of different things, and each of the accounts has a little bit of a cash amount that comes in, and as dividends get paid, they go into the core account. I don't auto reinvest dividends. I like to choose when I buy and sell things. So these accounts kind of build up over time, and so on $250,000, the result from the Fed rate cut results in about a $625 pay decrease that was dished out by the Fed to me, because I have cash sitting there. Now, I can take that cash and go put it into more investments. If I do various dividend paying investments, then I can harvest that back again. Um, but so that's kind of one thing, one side of the equation. The other side of the equation is that this year I started doing some margin investing, and I really wanted to try out the concept to see if I couldn't do a dividend arbitrage strategy. And so I moved some of my account balance over to Robinhood so that I had an amount to borrow against. And the reason why I chose Robinhood is because they have one of the best margin interest rates around. And so if you borrow more than $100,000 in your margin account, I had been paying 5.25% to do that borrowing. And I was just curious. So today I looked up, what is the margin rate? Did it have any difference? And it did. So I'll show that image in the video here. But yeah, that quick, my margin rate dropped from 5.25% to now it's 5%. So I just got a raise on all the borrowings that I have in the margin account. And so that kind of shows the difference between how interest rates punish savers and reward borrowers, I guess depending on which direction things go. And so on $100,000, that drop of a quarter point in the interest rate earns another $250 from the dividend arbitrage strategy that I'm using. So that's pretty interesting. So I moved a total of about $200,000 over to Robinhood, and my strategy or my goal was to kind of slowly purchase stocks when I felt like they were of good value and put them in that account, and then let the dividend difference slowly pay them off. And so I'm invested in a lot of energy master limited partnerships. So I own quite a bit of Hess Midstream, Plains All American Pipeline, USAC, it's like US Compression Partners. I think we have some Blackstone Minerals, BSM, a little bit of DKL in there. And I've kind of just been watching and picking up shares as they get reduced. And I'm watching the dividend amounts. And so I'm kind of picking things when they have a dividend return over 8.5%. So I think Western right now is at 9.5%. USAC and Plains are around that 8.5 range. I think BSM is actually higher, but I haven't bought a ton of that because it's been somewhat going down. But the arbitrage difference, I had, on average, they're paying about somewhere between 8.5 to 9% on this margin account, and then I had been paying 5.25% to borrow to purchase these extra stocks, but now I only pay 5%. So I actually got a raise between my dividend arbitrage. So I'm only paying 5% to borrow the funds to buy these dividend payers, but I'm getting, close to 9% of a return. So now I have a 4% dividend arbitrage, and I'm going to use that 4% to slowly acquire more shares of these companies. So year after year, I'll buy more stock, which will then pay more dividends. And my strategy, if the math just continues to work as expected, it'll take about 10 years of a time frame for me to fully pay off the value of this margin loan, just by the dividend arbitrage, because I'm making more in dividends than it's costing me to pay for this margin account. And so, the Fed is planning on reducing rates further. I think once in October, once in December. So I may get another 0.5% raise on this margin investing strategy, which will make it more profitable to me. And it's interesting because this is a lower cost on borrowed money to invest in the market. So I'm using borrowed money to buy assets, and those assets should produce an income for me. And by using other people's money, I'm increasing the amount of a return that I can get on my investment. So just thought I'd give you that little bit of an update. Already the Fed lowered interest rates, has lowered margin rates at Robinhood. And if you are borrowing funds, then you just got a raise on your funds. And just kind of in thinking, there's some folks that have been pointing at how high margin interest borrowing is right now. I think we just crossed over a maximum or something. And high margin rates can signal dangerous market tops, because retail investors get all invested and euphoric at the last time. But it's interesting because with the rate cut, everybody who's borrowed money on margin, assuming whatever brokerage they borrowed it from, if they all lower interest rates as quickly as Robinhood did, then everyone is now paying a little bit less on their margin loans. So the burden to carry those loans has just gotten a little bit easier, and thus anything they've invested in potentially has a higher rate of return. So that's kind of an interesting thought on margin loans. And it's certainly been a working proposition this year to borrow money in order to invest in the market, because the market is up. So everyone's a winner that's been in, or I guess on average, use a margin strategy. The turnaround is if the market goes down, you become losers. So, for me, on my choice was just to put money in things that paid a larger dividend. So even if the price went down, I'd still, over the long term, make money on this dividend arbitrage strategy. But I just thought I'd report, I just got a raise on my borrowed money, a pay cut on my money market accounts. But I thought it was kind of cool that the strategy that I implemented earlier this year to try to borrow some funds is now earning a little bit more than I had anticipated it would. So I'll keep you posted on my own experiments with this margin investing. I like my dividend arbitrage strategy. As long as the world doesn't fall apart, then I think I'll do okay. I'm not. I have other funds that could cover. If I got a margin call, I've got sources where I could pull funds to cover it. So, I'm not investing a huge amount from my funds, but I am trying the experiment of borrowing other people's money in order to see if I can't juice my investment returns in a fairly somewhat safe way. So there's one of my experiences. I don't know if you're interested in margin loans or not. I am trying it out for the first time in my life this year, so I can learn the whole system. And thus far, it's been decent. So, there's my experience. So, like, subscribe. Thanks for being a member or a subscriber, and we'll see you later. Bye.